Welcome back. Given that the inverted bond market and the overall bond market activity lately has been so active, thought it might be helpful to introduce. This is actually something it's brand new. I've been working on for quite a while. This basically shows us the progression of the bond market and what the bond market looked like at any specific period of time. So take a look at the left-hand side, the chart in blue. This shows us the Treasury market. We have the maturities at the bottom, the 1 month, 3 month, all the way to the 30 year. The histogram bars show us each respective Treasury bond's yield at the time. And then we have the actual time that this took place. So this is January 2022. This represents the last day of January 2022. So we can see at that period of time, this is what the Treasury market looked like. The 1 month bond paid just a little bit over 0%, almost nothing. 3-year bond just a little bit ahead of that, 22 basis points, all the way up to the 30-year that pays at 2.11%. Now, we can change this from January to February, and we can see how the market does in fact change. We can see in this case a 30-year bond did tick up to a small extent. Now we go to March, and we can see a flattening, where we see now the 30-year bond pays a very similar yield to the 10, the 5, the 3, etc. Again, take a look again at this is what February looked like, and this is what March looked like. See, there's a flattening. And remember, 2022, the S&P 500 hit a very significant high, and since then, it's seen a lot of weakness. Now we progress to April, May. 30-year bond ticks up a little bit higher, but still much more of a flattened yield curve. We go to June at this point, a flattened yield curve, which we know a flattened yield curve is not something that can stand or remain for a long period of time. It usually indicates that there's a big change that's coming pretty soon. Now we go to July. June, July is the beginning of the inverted yield curve, where we can see the 10-year bond paid at 2.67%, versus a 6-month bond at a 2.98%. We continue to August at this point. The yield curve still remains somewhat inverted. September, October, November, and then we see here in November the yield curve, the inversion of the yield curve really does begin to be exaggerated here. The 10-year pays a 368, the 6-month pays a 474, so over 100 basis points. Now, this is what December last year looked like. Still a very inverted yield curve. Now we go to 2023. This is January of 2023. We have the 10-year bond here that pays a 352. The 6-month bond pays a 480. So much more than even 100 basis point, more than a 1% inversion. Now, notice the highest yield offered January 2023, just a few months ago, was a 6-month bond. Notice how the capital does move, how we're going to see in the months of February, March, and now April, we're going to see even higher yields on shorter term maturities. So again, January, the 6-month bond pays the highest. We move to February, that's still the case. But now the 6-month bond ticks up to a 517. We go to March, and now the 4-month bond pays a 497. The 6-month bond pays a 494. I know it's not a big difference, but the change really is significant. Again, this is what February looked like. The higher yield is on the 6-month. The highest yield, I should say, is the 6-month. Now March, on the 4-month, and now finally present day April. And we see the highest yield is available on the 4-month at a 490 versus a 6-month that's just a hair below that, around a 482. And still very much an inverted yield curve where the 10 years at a 330. Now the reason why this is important is because we see that the capital is moving more and more out of the short-term bonds. You see, when the yields go up, it actually indicates that they're selling the bonds, that traders are selling the shorter and shorter maturities. One theory that I happen to subscribe to is that this is a signal that the end of the interest rate hikes are coming, meaning that if we treat the maturities, if we consider the maturities as far as some sort of forecast when the Federal Reserve may cease their interest rate hikes, when we see the highest yield on the longer term maturities, the bond market's telling us we have higher interest rates for quite a while into the long term, into the distant future. However, as we start to see the yields creep more towards the short term, that means the end of the interest rate tightening cycle is closer. Notice April 2022, the highest yield was on the 30-year. At the time, April 2022, it told us there's higher rates into the future. Fast forward to April 2023, 1 year later, this is now telling us the highest yields are closer in the future that's coming sooner, not the more distant future. Now, let's go back to 2008 because this was a very interesting period of time. We see here March 2008. This is a chart on the right-hand side, the red chart. March 2008, we see the highest yields on the 30-year bond. This tells us that maybe longer-term rates, higher interest rates are still very much in our distant future. 4.3% on the 30-year. The short-term bonds, for example, the 6-month only pays a 155. Well, let's see what 2008 looked like in terms of the bond market. Here's April. We have even higher interest rates. May, the trend continues. June, July, August, September now. Still very much a flat yield, or I should say a normal, what we would consider to be a normal yield curve. But notice what's happened. Even though it's a normal yield curve, notice what has happened to the yields. The 4-month bond only pays a 0.44% interest rates. Go back to March of 2008. The 4-month bond paid a 151. You see what happens is, and we know what happened in 2008, the stock market obviously took a huge hit to the downside. Well, this is what was happening in the bond market as the stock market was starting to crash. The yield was dropping very, very quickly on the short term. You see, when the stock market goes down, it's the short-term bonds that lead the charge lower. So take a look at the 6-month bond at a 155. That's in March. Fast forward to September. The 6-month bond pays a 178. Now take a look in November. 6-month bond pays a 0.9. December 2008, the 6-month bond pays a 0.37. Compare that again. March, the 6-month bond, 155. December, 6-month bond pays a 0.37. Point being is, as the stock market was going down in 2008, it was a shorter term maturities that were really collapsing. If we were to take a look at an uptrending markets, then we would see the opposite. We would see the longer term maturities, like the 10-year and the 30-year bond, those would be leading the charge higher. And we're going to spend quite a bit of time over the next couple months using this tool to really analyze the bond market to see what it's done, so we can try to prepare ourselves for the future. Also, let's take a look at the following green chart on the left-hand side. That shows us the bond market. This is starting out January of 2022. The white line is a 1-month bond. The red line is the 1 year. The light blue line is the 5-year, and the purple line is the 10-year. On the right-hand side, that's what the S&P 500 looked like at that period of time. And this chart shows us about 3 months of data. So the beginning of January 2022 through April, and the same scale on the right-hand side. So notice what happens with the white line as we move from January to now February. The white line, the 1-year bond, starts to travel higher. Remember, this is still a normal yield curve. This is the beginning of 2022. This is when the stock market hit its very significant high. And you'll see the yellow line, the right-hand side, the S&P 500, continues to travel lower. So now we go to March. S&P 500 continues to go down. Notice what happened to the white line. It still continues higher. April, charging higher. May continues to charge higher. The other maturities are pretty much locked in the trading range. The 1 year, the 5 year, the 10 year. All the action is in the short term. You see, this is we're approaching the inversion. June and then July. Notice now the 1 year, the red line is above the 5 year, above the 10 year. We have an official inverted bond market. Compare that again. January 2022, notice the red line was below, the white line was much, much lower. Fast forward to July. Now the red line's above, the white line's very close. August, September, October, November, and December. Now notice what's happening at this point. The red line, the 1 year, and the white line, the 1 month, are starting to cross down. Remember what happened in the prior chart when we saw in 2022, we saw the same occurrence take place. Remember, it was actually July. Well, June we started. Then July, there's the inversion. August and September. And what we saw, and we fast forward to December, what we saw are the short-term bonds going up. Remember in 2008, we compared March of 2008, the 6-month bond was at a 155. By December, the 6-month bond paid a 0.37. The short-term bonds collapsed. Well, maybe this is the beginning of that. The 1 year and the 1 month are starting to go down. Now I know it's really early, so it's hard to say if this is actually the case or not. Fast forward to January of this year, February, March, and now we see April. Where we stand in April, the 1 month and the 1 year are still very much above the 5 year and the 10 year. So point being is that I don't think we're yet at that place that we were in 2008. Maybe the analysis, the comparison is not accurate. But the fact of the matter is, when we see markets going down, we see the short-term maturities leading the way lower. When we see markets going up and a healthy trend to the upside, we see the long-term maturities trending higher. So far, we have an inverted bond curve. I think it's very important moving forward to make a note. When the inverted bond curve ends, how does it end? Do the short-term maturities cross down, or do the long-term maturities cross up? Like I said, we're going to spend quite a bit of time with this tool moving forward and comparing present-day bond market conditions to what we've seen in history, and hopefully that'll give us a little bit of clue as far as what might be to come in the future. We hope this has been helpful. We look forward to seeing you back soon.